Right, so let's go straight to my slides for today. So you should see these fairly shortly on your screen. So what you need to know, and as I said, this is a huge book. We're going to be, we're going at it at quite a pace. There's 10 chapters altogether. And I was just thinking to myself the last time I trained this book, and the last time I did train this, I did a weeks-long course for it. So we're going to try and condense that all into an hour. So I had initially about 370 slides. I've reduced that significantly, you'll be pleased to know. So I'm well below 100 now. But don't worry, I've pulled out, I've kind of limited myself to about 3 to 5 kind of key areas per chapter. I'll be spending a little bit more time on chapters 4 and 5, just purely because they've got quite a lot more to them. At the beginning of your book, and hopefully you've all got kind of an up-to-date copy of the book, there are only 4 learning outcomes in this. So actually the first 5 chapters that we're going to do today are all learning outcome 1, and that's 25 questions worth of the multiple choice. When I do these sessions, I focus mainly on the multiple choice because obviously we're not allowed to help you with specific coursework questions, but ultimately, hopefully some of you have got this soon and you can start to have your preparation for your revision soon, and it will accompany the on-demand course for those of you who want access to it. So when we get into kind of chapter 6 territory, it gets a little bit trickier to kind of go through because remember they're those case studies, and so they do that for 6, 7 and a little bit on 8 as well. So I'm going to dart across to some mind maps to go through those ones, but otherwise I'll stick with the slides for now. So without further ado, let's get going. And as I said, probably take queries at the end, so just jot down anything that you're wanting me to go over in a bit more detail and we can hit that at the end of the session. So the first aspect is the regulatory environment. Now this chapter is quite nice and short and sweet. It kind of takes you just among the regulatory environment for the claim side of things. And if you do the underwriting book, it would do the same for the underwriting. So they're very similar. So if you haven't done M80 yet, I would definitely kind of pair this with that one, just because it kind of has nice overlap there. Now, we're focusing primarily on these 3 regulators. So we're looking at the FCA, the Financial Conduct Authority, who want to ensure the relevant markets function well. Remember, their focus is on competition, integrity, and consumer protection. The PRA, who look at the whole market as a, as a whole wide variety of things, kind of banks, building societies, insurers. They are the authorization regulator for insurers, and they want to make sure that the safety and soundness of PRA regulated persons. And the one that's a little bit, well, not as common, I would say, or commonly known about, is the FPC, which is the Financial Policy Committee. And so they look for systematic risks and emerging risks across the market. Now, the key things that I've taken out of this chapter, so they go and talk about the regulators first, and then they start going into the actual real kind of regulations in the area of claims handling. So the things that I would definitely make sure that you're aware of is ICOBs. Remember, this is the Insurance Conduct of Business Sourcebook. Specifically for claims handling, ICOBs 8. Now, there are 4 kind of duties a claims handler has under ICOBs 8. That is to ensure that they handle any claims fairly and promptly, making sure that they're keeping the policyholder advised and giving them guidance when submitting a claim, making sure that any kind of settlement is not refrained, but for where there's evidence of fraud, so making sure that settlement can go through relatively smoothly. And then when settlement has been agreed on, making sure essentially that that agreement goes swiftly and you can pay out the claims promptly as well. We'll talk more about that in a bit more detail in a couple of chapters' time. If you remember from your certificate studies, you might remember PRIN, Principles for Businesses. Now, I would definitely just familiarise yourself with the principles that are relevant here for claims departments. So that's 1, 2, 6, 7, 8, and 9. And I've just got a list here of what those are. So integrity, skills, care, and diligence, customer interests. Number 7 relates to communication with clients. Then we've got conflicts of interest, and then finally trust. So all of these are really key to make sure that the claims department is adhering to them. So we've got a printable poster in this area on the course, so familiarise yourself with those when you get a chance. A couple of other handbooks that are relevant here, TC, which stands for Training and Competency, looking at making sure that you've got employees that are competent and not working above their means, but equally in the claims department, because there's so many different requirements that a claims handler has to kind of go through. So making sure that they're all competent within their work. Equally, we've got DISP. DISP is the Dispute Resolutions Handbook. So looking at complaints. So any complaint that's made can be oral or written, expressing some kind of dissatisfaction. And remember, Some complaints have to go through the complaint procedure for every firm. Typically, those firms have 8 weeks to respond, either kind of a final response or a written response as to why they can't provide a final response. We'll talk more about that in a second and what happens when that doesn't work. So we'll go on to the FOS in a minute. And then finally, the one thing I should just point out as well, this stems from lots of other kind of regulation from the FCA's perspective, that if you're having outsourced responsibilities given to third-party administrators or delegated claims adjusters or whatever else it might be, that regulation stays with the insurer. So you have to adhere to it. Your outsourced team or whoever you've appointed has to adhere to it, but the buck stops with you as the insurer. You can't delegate your responsibilities in relation to regulation. And then finally, just for this area, the FOS. So you've met this before in your certificate studies, just a few things to remind you of. Typically, the FOS steps in as an independent body if the complainant is eligible to go to them, and they've maybe exhausted the complaints procedure already within the firm. So remember, the FOS can award a monies award. At the moment, that's £355,000, a directions award to the insurer or the broker to do something in particular. And there's a piece of case law called Clark and Anor that basically says the policyholder or the eligible complainant, shall we say, can only accept what the FOS has given them, and then that's it. If they choose to reject it, they can then take the case further to court. So just remember, that's kind of the area there. One little note on case law whilst we're there, I've got a few bits of case law dotted around the slides today. Having had a look at the past papers recently, they don't seem to make their way into the multiple choice questions, but they will definitely be needed for coursework. So whilst I might make note of some of the really key important ones today, I wouldn't worry too much about learning. Certainly don't learn dates or anything like that, but just learn roughly where they are in the text so that you know what they're relating to. But otherwise, I think that's going to be much more examined in the coursework rather than the multiple choice. Okay, so that is number one. As I said, I'm trying to kind of limit this to a few key kind of points here, but we then come on to determining the existence of cover. So we're looking here at the structure of the policy, how it works, and what happens when there's ambiguity over policies as well. So chapter 2 is all around that area. We start with another principle that we've learnt about at certificate level, which brings back into focus contract certainty. Remember, this is the complete and final agreement of all terms between the insured and the insurer at the time that they enter into the contract, with documentation provided promptly thereafter. Now, if you ever hear the term contract construction, or that comes up in the exam, remember that's just essentially kind of the wording really of the policy. And so how a policy is constructed, if it's done badly, it has very severe implications. Not only does it lead to, disputes and then kind of eventually maybe court, but ultimately from the claims team's perspective, we have leakage, which is the overpayment of certain claims. And it also therefore affects the overall profitability of the insurer as well. So poor contract construction is really key to get right, making sure that that's there. One of the first aspects of this chapter looks at the notification of loss generally, and we will be going into a bit more detail on this in a moment. But there's a summary of the claims handling process, which we come back to later on. But I wanted to illuminate it now just so that it's in your mind. As a claims handler, it will be dependent on whether you're looking at first party or third party, but ultimately you're thinking to yourself, right, straight away, is the claim covered? Are the terms and conditions met? There's no exclusions or conditions that haven't been adhered to. Is there liability on the part of the insured? Certainly if it's a third party liability case, then that will be a case to think about there. What is the value of the claim? Sometimes also referred to as the quantum. Are we able to settle it if there's no coverage issues? And are we able to get any kind of recoveries, i.e. subrogation from other parties? So all of that will come into the mind of a claims adjuster when they're seeing this. Now, we've got the structure of the typical policy. Remember, we've got the schedule, which is the only personalized part of the policy. So things like name, policy period, address, things like that. I haven't included that on the screen because I thought that was relatively clear from some of the certificate books. So I've just pulled up some really key aspects here. So the insuring clause, also known as the operative clause sometimes, that you might have seen before, ultimately expressing the promise to pay. So it talks a little bit about the insured liabilities that are going to be covered in return for premium paid by the insured. Obviously, all of those things are subject to terms and conditions, and the insurer should, in theory, if it's covered and everything is above board, indemnify the insured. That's their promise to do so. Remember, any definition section, these are super key for claims adjusters. We're looking for key terms within the policy. We're looking for things that are capitalized, italicized, or bold. And so if they're in those kind of fonts, then you know that it's a defined term, and therefore you can go to the definition section and cross-reference what's there to see whether something's covered or not. Equally, depending on what type of policy it is, if it's liability or professional indemnity or something like that, you could have a limit of indemnity and or liability. If it's a property-based policy, you can have a sum insured or sums insured. Some of those limits are any one loss, some of them are each and every claim, and then some of them will be in the aggregate. So if you ever see this, the aggregate limit, remember, is where you have, for example, an aggregate limit of, let's say, £1 million, and then each claim that is paid out of that million erodes the limit. So once you've got to £1 million worth of claims, there's no cover there, unless, if you're doing other books, unless you've got a reinstatement clause. But for now, you don't need to worry about that. You just need to know that once that limit is exhausted, no further cover is available. So it goes to the insured to cover. Let's have another look at a couple of other bits before we move on to kind of the middle section of this chapter. The governing law and dispute section sets out the law and jurisdiction. So the law will be what law applies. So for us, it's English law, which typically applies to England and Wales, and sometimes Northern Ireland, depending on the situation. But the jurisdiction could, example, be English courts. So it's again where the case will be heard in the event of some kind of dispute. This middle section then focuses a lot on the triggers for cover. So we're looking at claims made and losses occurring. Now, just to remind you, and there's some good kind of animations in the course that go over this in a bit more detail, but remember, claims made is exactly what it says on the tin, regardless of when the actual claim has kind of accrued. So when the advice, for example, was given by your solicitor last year, it's when you've made that formal claim that the actual policy year is attached to. So if you had bad advice last year, you've realized in 2022 that you want to sue somebody, you sue them, they'll make a notification to their insurers and it will attach to the 2022 year. However, with losses occurring policies, these are things like public liability, whereby you'll have an accident. Maybe you had an accident last year in 2021, and it's the date of the accident or the incident that occurs. So we are going back to the 2021 year of account, regardless of when the claim is made. So that's the key distinction there. Now, this is only super relevant when we're thinking from claims made perspective of where there's been a notification perhaps, because under claims, we tend to have a claim that is a formal claim, and then we have what we call a circumstance, which is something that could develop into a claim. So we have certain obligations and duties under the contract for notification. So what to do in the event of a claim. If within the contract, a notification condition is normally what we call a condition precedent to liability, which means that if that notification is not met, the insurers can avoid paying a claim for that particular part, but the policy continues as normal, but they can avoid that particular claim. So it's really important that those notification procedures are followed by the insured. If they have a circumstance that's likely to give rise to a claim, we have what we call a deeming provision, and that's at the bottom of the screen there. I'll just read that out. Any claim arising from such circumstances shall be deemed to have been made during the policy period applying in which such notice was given to insurers. So what does that mean in practice? Well, if the insured realised that they'd given poor advice last year and they were thinking, actually, this is probably going to arise in a claim later on down the line, they can actually notify it to insurers as a circumstance. By virtue of the deeming provision, regardless of when the formal claim is made, it goes back to that particular policy year where the circumstance was notified. So that's why it's super key to make sure that you've got those distinctions down. Halfway through this chapter on, I'm just trying to pull up the page for you, there's a breakdown of the basis of each class written. It's on page 2/14. So I would definitely commit to memory the class of business and which basis it's written on. Very finally for this chapter, there's 4 cases. And as I said, I'm not going to spend too much time on case law because it's generally examined at the coursework level, but just to remind you of these 4 cases in relation to notification. So we have Layla and Lowe, which talked a little bit about circumstances likely giving rise to a claim, so more than a 50% possibility. Kojima looked at the fact that you can't just give a laundry list